Picture this. You're in your 40s or 50s on vacation, sitting on this tropical beach in the middle of the week, sipping away on Mai Tais and enjoying the tropical sun. This sounds like the American dream, unattainable for most, right? Well, what if I told you that you can achieve financial flexibility and freedom to do whatever and whenever you want? This very lifestyle is what I hope to achieve for my family and I. The key to all this involves dividends, and lots of it. Dividend investing, and particularly dividend growth investing, is just one of many investment strategies designed to afford the average investor the ability to take back control of his or her financial picture and bring flexibility and control to the forefront. What's going on, guys? This is Nick with Nick Does DGI, and thank you for clicking on today's video where I go over why I just subscribe to dividend investing and some benefits that come with it. I hope you enjoy this new format and find some value out of this video. If you would like to support this channel, I appreciate you clicking that like button. So let's get into it. I chose to be a dividend growth investor because I saw the benefits of growing passive income and what compound interest can do for your wealth. Growing up, my family was in real estate, and more specifically, they owned small commercial retail centers like the one in this photo. As a young 5-year-old, my grandpa took me along on his errands, which included visits into each unit, chatting with the store manager or owner, and then collecting a white envelope containing the rent check for that month. Obviously, my child brain didn't comprehend that this was what some people did for a living, collecting rent checks for their source of income passively. Now, as an almost 30-year-old, I see similarities between investing in real estate and investing in dividend stocks. Simply put, a dividend is a distribution of some of a company's earnings to a class of its shareholders, usually in the form of cash. When a company is able to grow its profit year in and year out, more money can be paid out to shareholders in the form of annual dividend growth increases. Dividend payments are completely optional and can be indicative of a company's prudent financial management and shareholder-friendly policies. And just like annual rent escalation clauses built into multi-year leases, focusing on solid blue-chip dividend companies will give you dividends that grow each and every year. For example, Target Corporation is a company we all come to love over the years. At 53 consecutive years, did you know that Target is part of an exclusive club of dividend stocks called the Dividend Kings that has raised its annual dividends at least 50 consecutive years? And there are other well-known dividend kings like Johnson & Johnson, Procter & Gamble, and Lowe's. 50 years is a long time horizon, and if companies have been able to grow dividends through plenty of notable world events, including multiple wars and economic recessions, then that is an indication of a financially stable company. So with that line of reasoning, I use my background in real estate to push at full steam ahead towards building a dividend growth portfolio with the hopes that it will produce several $1,000s a month in passive dividend income in conjunction with my other streams of income. There are a number of other appeals when it comes to dividend investing. The first has to do with the exact opposite of the safe withdrawal approach, or how much money can be withdrawn from one's account each year without running out of money before reaching the end of their lives. It has been industry practice that a safe withdrawal rate of 4% is sufficient to fund a prolonged retirement. This means that someone living off of Social Security and retirement savings will have to sell off 4% of their portfolio each year to fund that year. My primary disagreement with the 4% safe withdrawal rate is that you are perpetually selling off the underlying principal of your account to fund retirement, decreasing the total value of your portfolio. Plus, you are at time's mercy. For example, people who were just about to retire before the 2008 recession began to unravel saw their accounts crash over 40%. But the 4% rule requires you to sell even at the lowest time possible, and there's no telling when the market will recover. It wasn't until 2013, or almost 5 years later, that the market finally recovered to pre-2008 levels, meaning that the recent retiree would have had to withdraw at the bottom for 5 whole years. Another point of disagreement is that the safe withdrawal rate was popularized almost 30 years ago during the 1980s when retirees were not afforded the advances in medical technology and sciences. With each new generation, people are living longer and longer, and one worry is that you will outlive your retirement account. And let's not get into the topic of rising costs of higher education, housing, healthcare, and childcare. I'm a firm believer of creating and leaving generational wealth for my children and then for subsequent generations. Just as I was exposed at a young age to prudent financial education and learning the value of the dollar. I want to leave behind a legacy for my kids and educate them from an early age about the benefits of personal finance and investing. Another thing I like about dividend investing is that I can focus on the big picture time horizon and not get so bogged down on the small details. This bodes for the stock market. Seeing volatility in the market is completely normal, but it can be frightening for any investor. But by investing in blue chip dividend stocks, there's no need to worry. As previously alluded to, I no longer have to worry about the actual share price of a stock because I'll be relying on the dividend payments to fund my lifestyle. As such, many dividend investors actually welcome volatility and market sell-off so they can add more shares at a lower cost basis. And as long as you conduct your due diligence on a company's financials before opening a position and see that revenues and profits are growing safely each year, that increases the safety of the dividends. There's a name for these quality dividend stocks called sleep well at night or SWAN stocks. As the name implies, these are buy and hold stocks that can bring about a sense of peace and tranquility. In the past, I've tried all sorts of quote-unquote investing to quickly earn profits such as option trading and day trading. I've both gained or lost thousands of dollars in a single day, and this short-term volatility has taken a toll on my emotional health. The vast majority of traders cannot beat the market, and you're only bringing about unnecessary stress to your financial picture. But with blue chip SWAN stocks, you can be confident in your dividend investments and not look at your brokerage account for up to an entire year knowing that your dividend payments will continue to grow year in and year out. And to show you how compound interest can turn annual dividend increases into a solid dividend producing portfolio that will help fund your retirement, here is the projected value of my M1 Finance account, assuming a baseline 6.5% dividend growth rate and an annual contribution of $12,000 a year. Then this portfolio will be generating about $160,000 a year in dividends in 2045. Notice how you don't really see the impact of compound interest until year 15 or so. You need to let time do its thing, and by focusing on the long-term time horizon, you can rest assured that by retirement age, you could have a self-sustaining source of income independent of Social Security, and the option to retire before the age of 62 is a possibility. If you are a younger viewer watching this video, recognize that you have the most valuable thing on your side, and that is time. Getting started with investing at age 18 or even in your early 20s will set you up for life, and that is my hope with this channel. My biggest regret is wasting thousands of unnecessary dollars that could have been invested into the market following the 2008 Great Financial Recession. Accessing financial education even a decade ago was a lot more difficult than it is today, and that is one of my hopes for this YouTube channel. I want to empower investors young and old to take control of their finances and plan for the future. And I believe that dividend investing can gradually change your mindset to think about delayed gratification and the advantages of thinking about the long-term time horizon. And before we sign off for today, if you are interested in opening a new investment account with M1 Finance, which is the brokerage I use to build my dividend growth portfolio, please feel free to use my referral link in the description below. We will each earn $30 when you fund your account. Please note that this video is not intended as financial advice, nor am I a financial advisor. Past performance is no guarantee of future results, and please take the information with a grain of salt. Please do your own research and due diligence when deciding to invest in investable securities. If you found this video helpful, please consider clicking the like button and subscribing to my channel. Hit the bell notification to receive an alert on all the latest video. The YouTube algorithm likes these sorts of engagements and helps my channel gets noticed. Until next time, take care.